Well, I'll switch over. India's GDP growth for the third quarter of FY23 has slowed down at 4.4%. Mind you, expectation was at 4.6%, and 6.3% is where it was at in Q2. The centre has also revised the GDP numbers for FY22 to 9.1% from 8.7%. So on that higher base, and they've not changed the FY23 GDP estimate of 7%. It is interesting because the RBI in December lowered the country's GDP forecast to 6.8% for the current fiscal. Meanwhile, we also had the fiscal deficit data that was released earlier yesterday, which also shows that the deficit for the first 10 months of this fiscal has widened to 11.9 lakh crore or 67% of the revised annual estimates. Let's listen in to the Chief Economic Advisor V.A. Nageshwaran on what gives the government confidence of achieving that 7% GDP number this fiscal and how high inflation may prolong the rate hike cycle.
Statistics and program implementation has maintained the real GDP forecast for the current financial year at 7%. So if you look at the fact that the third quarter GDP estimate came in at 4.4% year on year, real GDP I mean, it is also because of the revisions made to the previous years when the base had gone up in constant prices terms. But overall, the growth rate that we need to achieve in the fourth quarter is roughly of the order of only about 4 to 4.1% to be able to hit a 7% real GDP growth. Inflation is softening. The pass-through from wholesale prices has run its course. Of course, we know that there have been some slight uptick in the inflation data for January, and RBI also has maintained its forecast that inflation will come down gradually. And we do have some uncertainties related to now the monsoon because of the El Nino activity, etc. So it is something that where we need to be ready with both supply side and monetary policy measures in the course of the next financial year.
And well, we'll stay with that. And what does this data really signify, and how are the markets going to read into this print? We have ET Now's consulting editor Maithili Bhusnaramat, who joins in, giving us more perspective on the same. Over to you, Maithili.
Well, this evening, the National Statistical Office released the GDP numbers and the gross domestic product numbers, both for Q3 of the current fiscal, that is October to December of the current fiscal, as well as the second advance estimates for the current fiscal. Remember, this data print is very important because this is the time when the CSO, or rather the NSO, revises numbers for previous years also. So we actually get not only the latest numbers for Q3 and the second revised estimates for the current year, we also get revisions for the past 3 years and the previous 2 quarters. So overall, what does it say about the health of the economy? Well, it seems to suggest that, well, the economy is in reasonable health. There is a slowdown, but overall the NSO has stuck to its first estimate of 7.0% GDP growth for this fiscal. Remember, the RBI had lowered its own estimate to 6.8%, but the NSO, the National Statistical Office, clearly does not see any reason to lower its estimate, so stuck to 7%. The third quarter, for which numbers were also released, GDP has come in at 4.4%, marginally lower than the earlier estimates, about 4.6%. The most disheartening number in these estimates, if we look at the disaggregated picture, is that manufacturing still continues to show a contraction. In the third quarter, manufacturing contracted by 1.1%. One can take comfort from the fact that this is a slower contraction as compared to the previous quarter, but that is really clutching at straws. The good news, of course, is that agriculture continues to do well, but here we have to keep our fingers crossed because the kind of heat waves that we're seeing in the north doesn't bode very well for agriculture going forward. So overall, the numbers are reasonably good. We have to keep our fingers crossed that agriculture continues to hold up, and the export slowdown that we're seeing because of the global slowdown and the impact on growth because of higher inflation, both do not make their presence felt very much. Particularly if you look at gross fixed capital formation as a share of GDP, that number has come down as compared to the previous quarters. So that really it's a mixed bag really, but overall nothing very alarming, but nothing too cheerful either.